Hello everyone and welcome back to another video. I'm Linima Falswal and today's video is going to be a little bit different from my previous videos. Previously, I used to be talking about what actuarial science is and what all exams you need to give to become an actuary. This video is going to be a little different in the sense that I'm going to be talking about a particular concept in regards to how it helps an actuary. As you would have guessed from the title of the video, I'll be talking about the global accounting standard IFRS 17 in context to insurance contracts. So recently I got the opportunity at my office to work on a presentation which required me to review about 40 insurers and go through their financial statements and see how they are commuting their liabilities, how they are calculating their assets, and what all changes have they brought into their system because of the implementation of IFRS 17. And it was a great learning experience. So I thought, why not share it with everyone, like what all I have learned, what all changes has this particular standard brought into the reporting structure of financial statements of the companies. So I'll be covering 4 major areas in this video. What is IFRS 17? How is it useful for an actuary and what all implications does it have on insurance contracts? The modes of measurement used under IFRS 17, its impact on actuaries. So let's get right into it. So what is IFRS 17? So imagine before IFRS 17, every company, every insurance company had its own way of calculating its insurance liabilities and recognizing profits. It was as if every company is speaking a different language when it came to their financial statements. This made it really difficult for the investors, analysts, as well as regulators to compare the financial statements of two different companies or even two different businesses such as insurance and banks. IFRS 17 is essentially a global accounting rulebook that has the following main goals. Number 1, to provide consistency and transparency across all companies and countries in terms of insurance. I'm speaking solely in terms of insurance over here. Secondly, it provides clearer information about the financial health and profitability of the insurance company. Third, profit recognition. Before IFRS 17, profits were recognized at the inception of a particular policy when the premiums rolled in. However, according to IFRS 17, profits are recognized as insurance services are provided. This better reflects how insurance works, like you earn the premium as and when the coverage is provided over time. Fourth, current values. Insurance liabilities are measured using current assumptions and estimates that reflect current market situation and the time value of money. So in short, IFRS 17 aims to bring insurance accounting in line with how other industries account for their services, providing a more transparent and consistent view of an insurance financial health. Now that you know what IFRS 17 is, let's talk about its key elements. First off, we have best estimate liability. What is best estimate? So basically, best estimate of all future cash flows related to a group of insurance contracts is like thinking that you have premiums or all the inflows that you expect to receive minus all the claims that you expect to pay and all the expenses related to the managing of these contracts. So it's that calculation that forms our best estimate liability. We discount them back to the present value using the rates that are provided. Now let's find the actuarial link to this. This is when the detailed cash flow projections come in. You'll need to be calculating the expected premium, claims and expenses, and crucially discounting them back to their present value using the current market consistent discount rates, reflecting upon the time value of money. Talking about the second element in IFRS 17, which is risk adjustment. Risk adjustment, commonly known as RA, is the explicit amount added to our best estimate liability to account for the uncertainty that is linked with the future expectation of our cash flows and the timing around it. So since we know that the PVFP or the present value of our future cash flows is like the best estimate, the estimate that we are making, there is always a chance of uncertainty that things won't turn around the way they should be in terms of our non-financial risks or the insurance risks, to be more specific. So RA essentially acts as a cushion around that estimate that we are making. So when I was also reviewing the various financial statements of companies, I came across this term called confidence level or the confidence interval. Like, there were various approaches that each company was using, but a very common term that I used to find was confidence interval. Later on, I found out that RA, that how do we measure RA? Like, how do we account for the risk adjustment? The way to do that is finding a confidence level, and most of the companies use that. So you'll be calculating this based on various actuarial techniques, often using the confidence level. For example, how much extra capital is needed to be X% confident that the liabilities are sufficient. It's about quantifying the compensation the insurance requires for bearing this uncertainty. Moving on to our next element, which is CSM. CSM, or contractual service margin, is arguably a new significant concept in terms of IFRS 17. The CSM represents the unearned profits that the insurer expects to earn over the life of a group of insurance contracts. Instead of recognizing all the profits upfront when you receive the premium, IFRS 17 says you should recognize profits gradually as you provide the insurance service. The CSM is essentially a deferred profit that gets released into profit and loss over the coverage period. Now, the actuarial link, to be very specific, is that the CSM is calculated at the inception or the start of the group contract. It's effectively the difference between the premiums you expect to receive and the best estimate liability plus the risk adjustment. So as the services are delivered, the CSM is amortized or released into profits. So when I was reviewing the financial reports or the financial statements, I would come across terms like release of profit or amortization and amortization of the profits. And later did I realize that these were terms related to CSM. As services are delivered, the CSM is amortized or released into profits. Changes to future cash flows that relate to future services also adjust the CSM. These three terms were very repeatedly used in the public disclosures of various insurers. And another thing that I noticed was there were different approaches that each company was following according to their own business. So in the next segment, we're going to be talking about the measurement models, like how every insurer looks at its own business and uses a different approach than the other. However, the basic essence remains the same. The fact that the reports are comparable, the public disclosures are comparable, the essence remains the same, whereas the methods that are used are a little different. So let's talk about the measurement models next. So depending on characteristics, there are various measurement models. First of all, we'll be talking about GMM or BBA. GMM means General Measurement Model and BBA means Building Block Approach. This is the default and most comprehensive model. It's called Building Block because it's literally building up the insurance liability from the best estimate liability plus the risk adjustment plus the CSM. This is used for most long duration contracts, especially for those with complex features or significant financial components like life insurance or long-term disability. This is where you'll be doing the full suite of actuarial calculations, detailed cash flow projections, discounting, risk adjustment, and the ongoing management of the CSM. The second approach that I found for a lot of insurers was PAA, or the Premium Allocation Approach. This is a more simplified approach for shorter duration contracts, typically those with a coverage period of less than 1 year. Like most general insurance or the PNC contracts, property and casualty contracts, would use this approach. It's a bit like the old unearned premium reserve concept. If you use PAA, you generally don't need to explicitly calculate and track a CSM, and discounting might not be required if the time value of money impact is very small. While this approach is simpler, the actuaries still need to assess if contracts are eligible for PAA and ensure that the PAA results are not significantly different from what the BBA would produce. You'll also still need to calculate the best estimate liability and the risk adjustment for incurred claims, or the claims that have happened but not been paid for yet, even if you use PAA for the remaining coverage. Our next approach is VFA, or the variable fee approach. This is like the modified version of the very first approach that we talked about, which is GMM or BBA, specifically for contracts where the policyholder participates directly in the returns from underlying items. So, in terms of insurance, whenever we are practicing as actuaries or like analysts at actuarial firms, we call these contracts unit-linked contracts or participating insurance products. So basically, the variable fee part means the amount the insurer earns that can change based on the performance of these underlying assets. Now, this approach involves more complex actuarial modeling to reflect how the policyholder's share of returns impact the insurer's profit and the CSM. So that was it from my side for this video. Please do let me know if you have any questions related to IFRS 17 or anything in general related to actuarial work. There has been a lot of IFRS 17 buzz lately, and I thought it would be a good opportunity for me to actually talk about it, since recently I had the experience of literally going through so many financial statements, like looking at the public disclosures of various insurers across the globe. So I thought that it would be such a good experience even for myself to just break down each of the concept, like all the to break down all the basic concepts. Basically, I did not go into much technicalities for this video, but it was something that I thought would be useful for everyone, since it was useful to me when I was comparing the results for the last year and this year. IFRS 17 has actually helped in making comparability much easier than it was before, because for the very first time when IFRS 17 was implemented, and there was this same thing going on where people used to go through the public disclosures and try to make a sense of what is profitable, what is not, and like what's going on. I think there was a lot of problem on the basis of how to compare businesses. Now that has become easier. There are the same elements that are used for all the companies, so it has become significantly easier, I would say. And yeah, that were my thoughts. Please do let me know if there is anything else that you'd like to know, or any suggestions about what my further videos should be. Thanks a lot. Thank you for watching. I'll see you in the next one. Bye.